Your Nvidia gains just got a hairline crack. The giant chipmaker beat revenue, but the margin guide slid to 74%. That single number threatens your $5 trillion index weight. Thursday, August 27, 2026. Today's agenda: Nvidia beat everything except the margin line. The index went nowhere. The names went everywhere. Real consumer read comes from dollar stores. Claims today, then Warsh on Friday. But while Nvidia stumbles, the broader index stays flat. Nvidia booked just over $96 billion of revenue, up 106% over the past year. Earnings were $2.22 against $2.09 expected. The data center business alone did $89 billion. Management guided the current quarter to $108 billion, $3 to $4 billion above the street. That would put a single company within touching distance of $100 billion in 3 months. And yet shares first fell about 2% on Wednesday evening, then turned up nearly 5% because the guide outweighed the margin. The reason for that whipsaw is one number. Gross margin was 75% in the quarter, and the next one is guided to 74%. That is the first guided decline in the figure that carries the story, because a monopoly giving a point back is under pressure. Management did not itemize why, though memory costs and the Vera Rubin ramp are obvious candidates. This reaches you whether or not you own the stock, because index weights do not ask. Nvidia is the largest member of the index at more than $5 trillion, so your fund is levered to this print. The chief executive said supply covers 70% growth, while demand runs higher, a bottleneck dressed as a boast. Watch for the margin commentary, not the revenue line. If 74% holds, the story survives, and the risk is it keeps sliding towards 70%. But the real story isn't in chips or gold. The indexes went nowhere. The individual names went everywhere. The S&P 500 finished 0.02% lower on Wednesday at 7,675. The Dow slipped 0.2% on Wednesday, and the Nasdaq a tenth. Underneath that calm, Meta rose after agreeing to settle a social media addiction case brought by 29 states for roughly $17 billion. Intuit sank about 10% on Wednesday because its outlook disappointed. Bonds barely moved after Tuesday's 8 basis point slide. Commodities did the day's real work. West Texas crude fell nearly 5% on Wednesday to about $81. Gold went the other way to $4,715, its best level in 3 months. Bitcoin was quiet at $78,586. The 30-year still sits near a 2-decade high, which means the long end has not healed. Now, look at Thursday. Contracts on the Nasdaq 100 rose about 1% on Thursday after the chip report. Asian futures are split, higher in Korea and lower in Japan and Australia. Read that split as the real verdict, because chip supply chains sit in Asia. Watch for whether the futures gain survives the American Open, since the last 6 quarters say it usually does not. And the inflation gauge confirms why rates might stay high. Set aside the chip complex, the most critical economic signal arrives today. Dollar General, Dollar Tree, Best Buy, and Ulta Beauty report earnings alongside several software names. The first 3 serve as honest consumer indicators because their shoppers lack financial cushions. They matter more now given falling consumer confidence to 89.4, a 7-month low versus a 90.2 forecast. Real spending was flat, and new home sales hit weakest levels since January. Dollar stores reveal if this softness exists in actual baskets or just surveys. Watch traffic versus ticket size, households trading down visit but spend less. Also watch for tariff comments, as these retailers stock imported goods facing new duties. Best Buy offers the sharpest test, because electronics are discretionary and imported. Ulta acts as a counterweight since beauty spending has held up, while other sectors have not. That divergence is the key read. A weak print here would signal September weakness better than recent inflation data. If all 3 guide down, expect a growth scare to replace the inflation scare quickly. The Fed's inflation gauge was hot. Prices was little changed monthly, and 3.7% annually against 3.6% expectations. Core prices matched forecasts at 0.2% monthly and 3.3% annually. The underlying trend held, while energy drove the headline increase. Rate traders moved immediately. Odds of a September hike rose to 40% from 36%. Money markets now fully price a hike by December, because a hot headline reprices the entire path. Growth offered no comfort either. Second quarter output stayed at 1.5%, but the price index inside it hit 6.4%, the highest reading in 4 years. Personal income doubled expectations at 0.4% monthly, yet real spending was flat. People earned more but bought the same amount, meaning real demand stalled. Expect Friday's keynote to be read against this combination and your savings rate. So let's wrap up with the numbers you need to watch. 3 markers in order. First, weekly jobless claims and wholesale inventories arrive this morning, and the retailers report through the day. Second, the Jackson Hole Symposium opens today, and the full agenda is published tonight. Watch for that agenda, because the list of papers usually tells you what the chair wants discussed. Third, Kevin Warsh gives his first keynote as chair on Friday morning, alongside Chicago business activity and final consumer investor mood. The theme this year is financial innovation and payments rather than the rate path. That means the market may get stablecoin policy, where it wanted a signal on September. Here is my call. I think Nvidia closes lower today despite the beat. That is because the stock has fallen the day after its report in 6 of the past 8 quarters, and the margin guide hands sellers a reason. Here is what would prove me wrong. A close above $220 that holds into the bell breaks that pattern outright. Watch the long end beside it, because your mortgage, your fuel bill, and your index fund all settle on what gets said in Wyoming. Nvidia booked just over $96 billion of revenue, up 106% over the past year. Earnings were $2.22 against $2.09 expected. The data center business alone did $89 billion. Management guided the current quarter to $108 billion, $3 to $4 billion above the street. That would put a single company within touching distance of $100 billion in 3 months. And yet shares first fell about 2% on Wednesday evening, then turned up nearly 5% because the guide outweighed the margin. The reason for that whipsaw is one number. Gross margin was 75% in the quarter, and the next one is guided to 74%. That is the first guided decline in the figure that carries the story, because a monopoly giving a point back is under pressure. Management did not itemize why, though memory costs and the Vera Rubin ramp are obvious candidates. This reaches you whether or not you own the stock, because index weights do not ask. Nvidia is the largest member